Hi everyone, I'm Ricardo Gonçalves. This is SBS On The Money for this Wednesday, the 10th of February 2021. It's your daily 10-minute business and finance news wrap. Later, we'll have a look at the day on the markets, but first, my special extended interview with the CEO of the Commonwealth Bank, Matt Comyn. It comes on the day where the bank lifted its dividend payout despite a fall in earnings, half-year cash profit down nearly 11% to about $3.9 billion amid COVID-19 provisions and record low interest rates. But those rates have seen more residential and business customers take out loans, and the recovering economy means many borrowers on holiday repayments are now back online. Earlier, I spoke with the CBA CEO, Matt Comyn. Matt, home loans and business lending are up. Consumers are depositing or saving more money. What does that say about the state of the economy right now?
Well, we've seen a marked improvement in a range of different economic indicators. As you said, we have seen a strong run up in a surplus savings balance. We think that's more than $150 billion across the economy. Housing has been particularly strong. We've been growing well above the rate of market growth for the 6 months. And pleasingly in business lending, we've been able to grow at 3 times the system growth, which we think is a really important element to support Australia's economic recovery, because seeing a pickup in business investment, I do think will be critical to Australia's overall economic recovery.
So based on what you're seeing on that business lending book, just how reliant are businesses on JobKeeper at the moment?
Well, look, we've certainly seen JobKeeper to be a very successful program, and it's supported businesses around the country. And we've seen that, and it's been a big contributor to the overall surplus savings balance, as I said. I think one of the key indicators will obviously be as the JobKeeper program does come to an end, and how effectively some of that household savings is used in terms of broader consumption, the impact and flow through into businesses around the country. And we're going to obviously try and support customers as best we can and make sure that we're facilitating broader economic growth where possible.
Are you comfortable with the impending end of JobKeeper?
Yes, as I said, it's a very large and very significant and successful program, and something of that scale was always going to need to come to an end. We do anticipate there'll be some issues for some customers directly, but where we sit today, as we look out, there's nothing that gives us particular cause for concern. But that said, you would have seen in our half-year result, we increased our loan impairment expense. We're now holding $6.8 billion for future potential loan losses. So we do feel very well prepared for a range of economic scenarios, but actually our base case is significantly more optimistic than that.
So you've got 25,000 home loans on deferral worth around $9 billion. What happens to them when JobKeeper ends and some of those people don't have jobs to pay back their mortgage?
Well, it's always really difficult to forecast that, and if we look at least of the customers who've exited already from home lending deferrals, so we've seen 92% go on to the same terms as pre their repayment deferral. We've seen a 3% go on to interest only. We've seen 4% requiring further assistance, and only 1% going into impaired or into default. Now, we do anticipate that there will be a higher proportion of some of those customers that are still currently on deferral that will need further assistance and support, and potentially that will extend during the course of the year. We'll do what we can to support our customers during that period, but of course one of the key indicators is going to be the ongoing recovery in the labour market. We're down at 6.6% unemployment. We believe that it will get down to 6% during the course of the year, which would be a very good outcome, but there will be customers who will continue to be directly impacted during the pandemic, and that's unfortunately one of the consequences of the context that we're in.
Matt Comyn there, the Commonwealth Bank CEO. Now, the bank declared a fully franked interim dividend of $1.50 per share, up 53% on the previous half, representing 67% of cash earnings. Now, remember last time the banking regulator forced the banks to pay out less than 50% because of the financial impacts of COVID. So I asked Matt Comyn his rationale for not paying more.
Yeah, sure. So it's a combination of both our strong capital position as well as our operating performance enabled the board to declare a fully franked dividend of $1.50, as you said, a 67% payout ratio. We do think that that sort of conservatism is appropriate given the current context that we're in. Our long-term target payout ratio from the board is unchanged between 70 to 80%, but given both the overall operating context and some of those risks on the horizon, we thought that was the most appropriate outcome, and it's a significant increase in the last dividend we paid, which is up from 98 cents.
You're seeing net interest margins fall. Are we at the low point?
Well, as you said, as low interest rates put a lot of pressure on net interest margins, of course, that's great news for customers who are borrowing. But we do see the impact of those lower rates that will continue to flow through in subsequent periods through a variety of different factors. We do hedge some of our deposits to insulate some of that impact in the current period. So it's reasonable to expect we'll still see further impact from lower interest rates on our net interest margin.
So we know the RBA says official interest rates won't rise until inflation rises comfortably, and we know that won't be until at least 2024. Does that mean mortgage rates will also not rise?
Well, it's hard for me to speculate on exactly what will happen with prices across different products over that time. Clearly, interest rates are going to remain low for several years, as you said, at least from a cash rate perspective. At least the governor is talking until early 2024. Interest rates are at record low levels, and we've seen a significant shift from customers taking advantage of 4-year fixed rates below 2%, very low, certainly relatively based business lending rates, and also customers availing themselves of that.
On the flip side though, what's your message to savers, those especially older Australians who rely on their savings accounts or returns for deposit type asset classes?
Well, unfortunately, it is a very difficult environment for depositors and savers, and the other side of people who are borrowing and receiving record low rates is customers who are receiving the lowest rate they've seen on their savings product, on their term deposit. We hear from those customers directly, regularly. Unfortunately, as rates are likely to remain low for several years, it is very difficult for customers who are looking to use those deposits and income from those for their retirement.
Just finally, you've made a lot of investments in technology and products like Buy Now, Pay Later. Where do you see future growth coming from?
Well, we see digital and technology more broadly at being at the heart of our strategy, making sure that we're delivering the best possible services and experiences for our customers. We've seen significant growth in the use of our mobile app. We've got more than 7.5 million digitally active customers. So we're going to continue to innovate across all of the products and services that we provide. You mentioned payments, but we also just want to make it easier for our customers to stay in control, to be able to help them budget for the future, and to make sure that we're providing as much value to them in the way that they want to live their financial lives as possible.
Commonwealth Bank CEO Matt Comyn there, and shares in the bank fell 1.5% today. The broader market, the S&P ASX 200 rose 0.5% today, 6,856. Tech stocks did best. The best performer on the 200, Zip, up by 12%. For more on the day's market action, I spoke with Minnett, Francesco de Stradis. Francesco, the market is up today. Why?
Yeah, the market's actually pretty choppy today. I think the movements from high to low are about 0.75%. So it is pretty choppy on fairly low volume. Look, I think the market's been driven a little bit higher because of the US futures that have come on board. The reporting season at the moment is a bit mixed. Some people saying positive, but a bit mixed, I'd say. But I think the US futures has driven our market a bit.
Speaking of reporting season, Commonwealth Bank, the big one today, half-year numbers. What did you make out of it?
Yeah, look, the numbers came in as we expected them to be. The dividend at $1.50, which is where we expected us also. I think key to the numbers was the net interest margin. It was about 10 basis points lower than it has been historically. So I suppose the big question here is this the low point of a low interest rate environment? The other impact on the numbers, obviously, is coronavirus restrictions. And I think we'll start seeing the other side of that. Guidance was not forthcoming, but outlook statement was pretty much cautious, I would say. They're looking at positive, but obviously in the background with economic and health impacts.
Should investors be happy with that increased dividend, 67% payout ratio? And what does it say about dividends going forward across the sector?
Yeah, look, I think investors are going to be happier than they were at the full year dividend, but they're still about 25% below where they were on the previous corresponding period. So, the previous corresponding was a $2 dividend. We're looking at $1.50. APRA has, I suppose, relaxed their restrictions on retaining earnings for the banks. So CBA has seen this as an opportunity to actually increase their dividends from where they were on the previous half, but they're still lower than they were on the previous corresponding period.
Okay, any other profit numbers catch your eye today?
Yeah, there was a couple of mixed numbers, I suppose. It's IAG, the big insurance company. They put out some numbers, and look, they had a loss, but they've had to sort of capture some of the coronavirus effects as well. But what was, I suppose, positive on the insurance side of things was the increase in premiums that they're picking up. So that was a positive on IAG. CIMIC, the big construction company, it's had a negative. Its stock was off about 5% at one stage through trading.
So do you think, given what we've seen so far and as we come out of coronavirus, this will be a good reporting season? And is there any opportunity for investors?
Yeah, look, I think expectations have been muted because of coronavirus. So the question is it a good reporting season? Relative to people's expectations, it probably will be. But from where expectations were prior to coronavirus, we're probably looking at it being a bit muted. So opportunities in the market, look, there's always going to be opportunities, and I think IAG sort of set the ground rules there on the insurance side of things today. So maybe having a look at some of the other insurance stocks might be impressive. And obviously the resources sector, with the iron ore price being so high, I think some of the iron ore producers are going to post some really good numbers.
Can we talk about Crown? Its shares are back online after being on a trading halt given its Barangaroo woes. What's your take on the company? Because I've actually noticed a few brokers have still got a buy recommendation on the stock.
Yeah, well, at Ord Minnett, we've got a hold recommendation. We've had it on there for quite some time. I think probably being more cautious than anything. Look, I think what will happen is there'll be some shuffling of the decks at board level and at ownership level. And I think at some stage in the near future, they will receive a license for casino. It might have some restrictions around it to begin with, but over time, those restrictions will lift. So, look, we saw the share price as it came on trading get sold down quite heavily, but it's recovered quite a bit from where it was in early trading. It's still down on the day, but not as significant as it was.
Francesco de Stradis there from Ord Minnett. Tomorrow we'll be speaking with the CEO of Telstra, Andy Penn, in another special extended interview. That is SBS On The Money for this Wednesday, the 10th of February 2021. I'm Ricardo Gonçalves. You can follow me on Twitter and Instagram at BusinessRicardo. This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.